Silver crashed 52% from its all-time high in January this year. Yet Wall Street still calls this the buying trade of the decade. Before we break down every number, hit subscribe to Macro World channel. This channel tracks gold and silver like nobody else on YouTube. Because what happened this year in metals has never happened before. Gold hit an all-time high of $5,595. That happened in January 2026, a record nobody saw coming. Since then, gold has fallen nearly 28% from that peak. Today, gold trades near $4,000 per troy ounce, still elevated. Silver's story is even wilder, and the numbers are truly staggering. Silver touched $121 an ounce in January 2026. That was an all-time nominal high, smashing every previous silver record. Then came the crash, and silver fell 52% from that top. Silver now trades around $58, still historically high by any measure. So why does Wall Street still call this the decade's biggest trade? The answer lies in 7 numbers, almost nobody is talking about yet. Number 1 is central bank buying, and it remains absolutely relentless. China's central bank has bought gold for 20 straight consecutive months now. In June, the People's Bank of China added 15 tons of gold. That was its largest single monthly purchase since 2023 began. Central banks buy gold even while retail investors panic and sell off. That divergence between institutions and retail traders tells you something important here. Number 2 is the gold-silver ratio, and it currently sits near 69. That means 69 ounces of silver equal 1 ounce of gold. Historically, whenever that ratio spikes this high, silver eventually outperforms gold sharply. The long-term average ratio sits closer to 50 or even 60 ounces. A move back toward that average alone would send silver dramatically higher. Number 3 is silver's brutal supply deficit, which keeps widening every year. Mine production simply cannot keep pace with soaring global industrial demand today. Roughly 60% of all silver demand now comes from industrial applications. Solar panels, electric vehicles, and electronics all require enormous amounts of silver. Unlike gold, silver actually gets consumed and destroyed in industrial manufacturing processes. That destruction permanently shrinks available above-ground supply year after year after year. Number 4 is what happened to both metals throughout 2025. Gold surged 66% in 2025, a genuinely historic annual gain. Silver did even better, surging 135% across that same year. That silver rally ranks among the biggest annual moves in modern market history. Yet even after that explosive run, silver remains far below its old peak. Number 5 is what major banks are actually forecasting for 2026. Goldman Sachs recently set its year-end gold target at $4,900. JP Morgan's fourth quarter target for gold sits at $4,500 ounce. Macquarie forecasts an average 2026 gold price of $46.41. Every single major forecast sits well above where gold trades today right now. For silver, JP Morgan projects an average price near $81 this year. That target sits roughly $23 above where silver trades right now. That gap between forecast and reality represents a massive potential upside opportunity. Number 6 involves the Federal Reserve, inflation data, and looming interest decisions. U.S. inflation remains elevated, pushing expectations toward another Federal Reserve rate hike. That hawkish shift is exactly why both metals corrected sharply lately. But historically, metals bottom before the Fed actually finishes its tightening cycle. The July 28th and 29th FOMC meeting could reshape this entire narrative. Number 7 is geopolitical risk, which has intensified dramatically across 2026. The United States and Iran have exchanged direct military strikes this year. Oil prices are climbing, and that historically fuels inflation and safe demand. Gold has always thrived during periods of war, chaos, and instability. Yet paradoxically, this recent conflict actually pressured gold prices lower, not higher. That's because rising oil raises rate hike odds, which hurts non-yielding gold. It's a strange tug of war between safe haven demand and interest rate fear. This tension is exactly what creates historic setups like the one forming now. Let's put all 7 numbers together and see the full picture emerging clearly. Gold sits 28% below its high, yet still 18% higher yearly. Silver sits 52% below its high, yet still massively above levels. Central banks keep buying gold aggressively while retail sentiment remains pessimistic today. The gold-silver ratio sits far above historical norms, favoring silver's eventual outperformance. Silver's supply deficit keeps widening as industrial demand consumes physical metal permanently. Every major bank forecast points meaningfully higher than today's actual trading price. History shows metals often bottom before the Federal Reserve finishes tightening policy. Geopolitical tension keeps rising, historically one of gold's strongest long-term price drivers. This is not speculation. Every number here comes from verified institutional sources. The World Gold Council puts gold's fair value near $4,100. That means today's price sits below even the Council's conservative fair estimate. In other words, gold may already be undervalued according to its framework. Silver tells an even more compelling story once you examine every number. A 69-to-1 ratio has historically marked major bottoms before explosions. During the 2011 silver rally, the ratio also sat near similar levels. Silver eventually surged past $48 during that historic 2011 spike. Today's setup shares striking similarities, but with far stronger underlying fundamentals. Back then, silver wasn't facing today's massive solar panel and EV demand. That structural industrial demand simply did not exist at that same scale. This time, the demand story is permanent, not just speculative trading momentum. That permanence is exactly why institutions like JP Morgan remain aggressively bullish now. Meanwhile, retail investors are doing the exact opposite of smart money moves. Retail selling into weakness while institutions accumulate is a classic historical pattern. This exact pattern preceded nearly every major precious metals rally in history. So the real question becomes whether this correction is actually final washout, or whether deeper pain is still coming before the next major higher. Every number so far points toward accumulation, not capitulation for patient investors. But numbers alone don't tell the whole story without proper historical context. The next set of numbers reveals exactly how historic this setup is. Stick around, because what comes next changes everything you thought you knew.